Hello and welcome to Strategic Alternatives, the RBC Capital Markets podcast. Please listen to the end of this episode for some important disclosures. I'm John Suin, Assistant Vice President of Global Commodity Strategy and MENA Research, joined by Helima Croft, the Global Head of Commodity Strategy and MENA Research here at RBC Capital Markets. Today we're talking live from RBC Capital Markets Global Energy, Power, and Infrastructure Conference here in New York City. And Helima, this is really a timely moment for us to have this conversation. We're a little over 3 months into the Iran conflict. We've lost over 1 billion barrels of Middle Eastern supply over those 3 months as we're going into peak demand season in the summer. Why are prices sitting at the levels that they are currently sitting at?
Well, first of all, John, it's so great to be with you this morning. And thank you, everyone, for listening in. I think this is such an interesting question because we have the largest physical energy supply disruption in history. As you've mentioned, we've crossed the billion barrel disruption mark. We are now in the 4th month of this conflict. And the question is, why are prices not higher than they were during the Russia-Ukraine war, where we basically exceeded $128 because of fears of a 3 million barrel day disruption, which didn't materialize. And now on any given day, you have between 10 and 12.5 million barrels off the market, depending on how many ships Iran lets cross through the Strait of Hormuz. But there's no way around this, that this is a very serious energy crisis. And does it warrant Brent prices being below $100? I would say absolutely not. Now, the question is, why are we here? And I think, first of all, we've had substantial inventory drawdowns. And now everyone is very focused on, are we getting close to potential tank bottoms with inventories? But unlike the case with Russia, when we started in a much more fragile inventory situation, we started this war with very robust inventories. So that has been a first line of defense in terms of shielding the global economy for the worst case scenarios from this war. Also, we had the largest IEA coordinated stockpile release. That also has been really, really important in terms of, ensuring, again, both the commercial inventories, the IEA stockpile releases. That has provided the sort of barrel buffer. But now we're reaching the kind of limits of that policies and those inventory draws. So I think the next weeks and months will be really important in terms of where we're going in terms of potential physical shortages. The other issue, though, we've talked about is the sort of memento mindset. Since this war started, the White House has been relentlessly focused on telling the market that the war will be over soon. Remember, we had that big run-up in prices on the Sunday. Midday Monday, President Trump came out and said it's going to be a short war, and we sold off. And for a large segment of the market, they've been focused on the idea that this has to end soon. It's basically the tomorrow that never comes. It's always a day away. The peace deal is always a day or hours away, according to certain media outlets, but that really just has not materialized. But the idea that this could be over soon continues to sort of set expectations about the impact of this war. And so I think as we go through summer, and if we don't get a reopening, I think we're going to hit probably a physical wall, even if we don't hit the price wall before that.
We've been kind of on a MOU watch
Since May 6th, actually.
Since May 6th. Almost a month away from that, and there still really hasn't been a lot of, progress towards that.
I mean, I think this is extraordinary. The fact that we had the announcement of an imminent memorandum of understanding, basically to extend the ceasefire so they could talk about all the issues that have bedeviled the U.S. Iran relationship for years in terms of the nuclear file. And it doesn't materialize, but every time a news outlet announces it's about to happen, we have a sell-off. And I just think back to last week where we had this flare-up of, drone strikes and missile strikes between the U.S. and Iran. And you would think that would have been sort of the big story coming out of Memorial Day weekend. And yet we had an announcement that the Iranian government was considering, I think it was an unofficial initial memorandum of understanding. And we sold off 5%. Even though we had just had missile and drone strikes, everyone was focused on, well, there's this MOU coming. Again, it's soon going to be a week since that last MOU watch. But where we are now in terms of the negotiations. The Iranians have signaled that they have stopped negotiating. Now, President Trump this morning said we could get a deal within a week. But I think there's an element within the IRGC that has come to the view that the longer they drag this out, the longer we stay in this no active war, but minimal oil situation, that time is on their side because they are determining which few ships are getting through every day. You do have to at least coordinate, potentially phone up a hotline and pay in Bitcoin to get passage through the strait. And so from the standpoint of the IRGC, they're not in the absolute worst situation. There are reports that they've used the ceasefire to replenish their drone stockpiles, to rebuild missile capabilities, repair infrastructure. So are they desperate to sign a deal? Probably not.
To be clear, too, we're talking about an MOU or a framework of some sort that is primarily focused on reopening the Strait of Hormuz. That's the period before you start to negotiate these core issues that have plagued U.S. Iran negotiations for years. Where are we standing on those core issues right now?
I mean,
nuclear.
This is such a challenge, John, and we talk about this all the time. I mean, the issues that have, again, even blocked the Biden administration from being able to revive the JCPOA nuclear agreement, we haven't settled that yet. We haven't settled the issues of what will be the Iranian residual enrichment capabilities. What do they have to do with their stockpile of highly enriched uranium? What is the path to sanctions relief? And again, I think this is something a lot of market participants, they don't want to get bogged down in the details, but the details of sanctions relief is really important because the most onerous economic sanctions on Iran have been imposed by the U.S. Congress. And they have stipulated a whole process of congressional review to even waive those measures. So President Trump doesn't have unilateral authority just to vacate the sanctions. And that was certainly an issue the Biden administration encountered as well, is the Iranians wanted a full repeal of sanctions. And the Biden administration kept saying, it has to go to Congress. So I do think that that is still going to be a very, very significant stumbling block. Sanctions relief, these other issues around the nuclear program. But now, importantly, and this is where I think things are really different this time around, is the Iranians are insisting that there is no deal that doesn't end with them in control of the Strait of Hormuz. And so that's why we've come to the view that essentially February 27, 2026 will likely be the high watermark for flows through the Strait of Hormuz. That if you end up in some type of reopening scenario, as long as Iran is exercising some form of operational control over the strait, we think that flows will be lower, appreciably lower than they were before the start of the war. Because I think there'll be certain shipping companies and insurers, particularly Western ones, that won't feel comfortable either having to coordinate with the IRGC, which is likely they'll be sanctioned, to pay the IRGC. They're going to be concerned about the risk of drone strikes, missile strikes, if you have sort of a breakdown. So I think they're going to potentially stay away for a while. And you could end up with it looking a lot like the Red Sea. We're 1 year away from when the U.S. signed a deal with the Houthis to end hostilities in the Yemen war. The Saudis have essentially signed a peace agreement with the Houthis. And yet, flows are substantially lower going through Bab el-Mandeb than they were before that conflict started. And so the question is, are we going to look something like that? Are we going to basically be materially lower when we do have a reopening? I don't think you can put this genie back in the bottle. And you have clearly a situation where Saudi Arabia is likely to continue to use the East-West pipeline and bypass Strait of Hormuz as much as possible. The Emiratis are focused on building their second pipeline that runs straight to Fujairah. But as you know, John, we've talked about this, none of those solutions are 100% risk-free. The East-West pipeline has been secure because the Saudis came to terms with the Houthis. Fujairah has been repeatedly attacked by the Iranians. And so the question is, how can you build 100% secure offsetting infrastructure? I think that's going to be the key challenge coming out of this war.
What does the road back look like? Even in the best case scenario, we've heard, from producers in the Middle East that this is a long-term process back to where we were in February.
What is so striking, John, is we did the interview with Dr. Sultan Al-Jaber, ADNOC Group's CEO, And it was so interesting because he said it's going to take at a minimum 4 months to get back to 80% of pre-war levels. And you would have thought that day to have the CEO, one of the most important national companies in the world, come out and say, at a minimum, best case scenario, 4 months to get back to 80, but the war has to end before you can even start that clock. That would have been something that market participants might have focused on. But instead, just right after that interview, there was another anonymous source saying, we're within hours of getting a deal. And the market sold off on the deal is coming within hours. So at every point where you could say this should be an important inflection point, this CEO saying 4 months back to 80, we also had a very large EIA, crude draw that day. I think it was like over 9 million barrels. But the focus of most market participants was on an anonymous source saying a deal was coming within hours. It was like a mirage. The deal never materialized.
I think that's a great place to end this. It's, going to be a challenge as we think about navigating this going forward. Thank you so much.
Thank you, John.
You've been listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on June 2nd, 2026. Listen and subscribe to Strategic Alternatives on Apple, Spotify, or wherever you listen to your podcasts. Thank you and see you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.